think the Fed is still very much in data-dependent mode, and we've got two key bits of data coming up before they next have to make their rate decision. The underlying driver that we're watching very closely is wage inflation, because for all of the data that's coming out, to us, wage inflation running at 4 to 5% in the US, it's just too high to get back to the Fed's 2% inflation mandate anytime soon. We think to get back to those kinds of levels, you need to see wage inflation more in the 3 to 3.5% level, and with this very strong demand coming through, sort of versus labour supply, they're going to have to push a bit harder. So, I think Powell's towing that balance at the moment, given the degree of uncertainty out there. But the data through January, and I think the emerging data through February as well, still supports the notion that higher for longer in the short term at least is probably the right call.
So there's a big if in there still, and we know we've got the payrolls on Friday, then we've got the inflation print next Tuesday that'll be very important for determining whether it's 25 or 50 here. So how should investors think about what they do over the next 2 weeks?
Yeah, so when we're looking at current opportunities, the thing that we think is a comfortable trade with a good risk reward is thinking about short-dated fixed income, so specifically US investment grade credit. If you're thinking about maturities of 1 to 3 years, picking up a yield of 5.6, 5.7%, that to us feels like quite a comfortable trade, greater certainty of return over that period of time. Something that feels less comfortable within the fixed income space is actually extending duration, so taking that out to 5 to 6 years. But why that's interesting to us is that the implication of higher rates or higher for longer could be that recession comes early next year, and that perhaps it's on the deeper side, and in that situation having a bit of duration will help. So I think the fixed income complex broadly, given the starting point of yields, is more interesting to us than it's been for many years.
Interesting your point, and I'll pick you up on that about median salaries. You said the wage inflation being too high, 4 to 5%, you wouldn't see with a 3 handle as well. Median salaries and household income in the States didn't move for decades. And actually, I'm kind of, from a social point of view, and I don't mean to paint my colours to any particular mast, I'm really pleased that actually your median salaries are actually finally beginning to increase across the US as well. And actually, there's a slight, and I only say slight, redistribution of the income curve, with the C-suite still making vast amounts of money. I'm not worried about them. But actually, it's a good thing for the economy, isn't it? Which is based so much on the consumer, that actually the core US consumer is earning more money.
I mean, look, it's inflation is something that we wanted. Wage inflation or general inflation, we wanted that for years, and inflation in the 2 to 3% range is healthy, and we've seen higher nominal growth come through in the last 12 months, actually really helped the corporate earnings picture. But equally, supply-demand balance is very important, and I think what we've seen is structural changes in the labour market that are reducing supply, meaning that to get that balance, you need to see a bit of demand weakness, and for that to feed through into the wage.
Changed that much? I mean, one thing that we've all looked at, you've us around this desk many times, I'm sure, is the participation rate, which is it's not changed that much from where it was pre-COVID.
So I think there's still a change in the participation rate when you look particularly in the older generation.
Yeah.
Then whether it's early retirements and the like, I'll skim over that. Then there has been a meaningful change, and also in the way people want to work as well. And so all of that, I think, is feeding through into the wage numbers and therefore into the data.
I'm just reading an interesting report from Brookings, and they're pointing out the same thing effectively, that if you look at the labour market, wage growth is 1.5 points faster than it was prior to COVID. So even though we are seeing some slight improvement on the annual figures, month on month, the last 3 months, you're still seeing heat in the system. What does it take? What sort of level do we need to see on the terminal rate for this to really take the heat out of the services side of the economy now?
Yes, it is the services side, as you mentioned, Karen. So we have got in our numbers another 2 or 3 25 basis point rate hikes to get us up to the we don't have 50. We're also, like Powell, staying data dependent and keeping our options open. For the moment, we're sticking with 25, and we will see over the next few days as that data comes out where that takes us to.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.